Welcome to the debate. So, why does it feel like the most critical components of the entire digital economy, I'm talking about memory and processing power, are just, well, impossible to buy right now?
We are witnessing a massive seismic event in the supply chain. The AI revolution has triggered a crisis in semiconductor supply, specifically for the twin engines of high-end compute, DRAM and high-end GPUs. I mean, when you look at the raw data, it is extreme, a 171.8% year-over-year DRAM price surge.
And the reaction to that price surge has been immediate and, let's be honest, frankly hyperbolic. Suddenly, memory chips are the new gold. It's a very catchy narrative, but it's one that demands, I think, a rigorous, almost cynical intellectual scrutiny. That scrutiny is exactly why we're here. This whole discussion is really driven by recent analyses of this trend, including the, I'd say, provocative research presented by Slava Solidki over at DRAM.Gold, which really forces us to confront the unprecedented financialization of AI hardware. We've seen figures confirming over $11 billion in GPU-backed lending. So the central question, it's not academic anymore. Does AI compute DRAM GPUs now function as a legitimate, modern, strategic asset? Or is it just a transient, technologically obsolete commodity all dressed up in a financial bubble?
Well, I'm going to assert that the fundamental lack of durability, the excessive volatility, and just the sheer speed of technological obsolescence prevent this hardware from ever being true enduring gold. It is a spectacular commodity bubble.
And I will argue that its structural, strategic importance, which is confirmed by its capacity to secure institutional collateral and its necessity for geopolitical leverage, validates its status as a new high-stakes asset class. It is the defining resource of the 2020s. I see why you emphasize the risk. I do. But let me offer a different perspective here, one that's rooted in supply-side economics. This scarcity, it isn't an accident. It is structurally engineered. The demand is purely inelastic because every single major AI player requires these specific chips. And what's more, the three-firm oligopoly, Samsung, SK Hynix, and Micron, which controls 95% of global DRAM production, is actively prioritizing the manufacturing of the far more profitable high bandwidth memory, HBM, over traditional DRAM.
This deliberate capacity realignment, it basically guarantees that the current supply squeeze will persist, potentially until new massive fabrication plants come online, maybe in 2027 or 2028. This isn't just scarcity, this is scarcity that's been weaponized for maximum profit extraction. And the financial world, it has accepted this reality.
That's an interesting point, though I would frame it very differently. While the weaponization of scarcity is real, this whole new gold narrative just collapses under every single defining metric that financial history has set for a reliable asset. Gold maintains its purchasing power across 5 millennia. It often serves as a counter-cyclical hedge. Meanwhile, the core material we're discussing, the DDR4 standard, is already receiving literal end-of-life notices from those same manufacturers. The comparison it's a grotesque conflation of temporary strategic importance with the long-term store value characteristics you need for an asset class like gold.
But that's where the definition of strategic asset has changed.
The volatility tells the story of transient greed, not strategic stability. Gold exhibits, an average annualized volatility of 16%. DRAM, it swings between 50 and 175% annually. That extreme, unstable movement is the definition of a textbook boom-bust cycle, manufactured by the very same oligopoly that's profiting from it. And crucially, it lacks fungibility. You cannot swap DDR4 for DDR5. Samsung's own mobile division proved this when they chose Micron chips over their own for a specific flagship model. Most fatally, the material isn't physically rotting, but financially it's worthless within 18 to 24 months due to economic obsolescence. You're arguing that high-speed depreciation is a feature, and frankly, I just don't buy that.
I think we need to interrogate the collateral market more closely, because the institutional acceptance of this hardware is really the most powerful counter-argument to the commodity bubble label. I mean, you can't really call something a bubble if Blackstone is funding it.
I agree that the scale of financial engagement requires a precise look. So let's talk about the collateral contradiction. You cited some staggering figures. CoreWeave securing $7.5 billion in debt financing backed by hundreds of thousands of NVIDIA GPUs. And I grant you, those numbers are astronomical. However, that $11 billion lending market is a mirage if you believe the physical hardware itself is the asset. Lenders accept these GPUs as collateral only because they generate massive, guaranteed cash flows through cloud rental agreements with customers like Microsoft and OpenAI.
So what? That distinction is semantic?
No, it is not semantic, it is structural. CoreWeave generates nearly $2 billion in annual revenue. That revenue stream is the primary security. The physical hardware, the GPU, is merely the specialized machine tool required to create the cash flow, and it still depreciates on a standard 6-year schedule. This is textbook asset-backed finance built on service contracts, not asset as gold. I mean, if these chips were truly a store of value, you could walk into a bank with a box of RTX 4090s and get a personal loan. You can't. Furthermore, institutional lenders require the use of UCC-1 filings, which register the physical equipment as collateral, and special purpose vehicles, these specific legal entities designed to isolate the risk. That extreme level of legal complexity is a massive red flag that this is volatile machinery, not stable currency.
I come at it from a different angle. You're trying to apply a 20th century definition of a hard asset to a 21st century strategic resource. The asset's intrinsic power, its ability to generate that cash flow, which is only possible because of its engineered scarcity and its state-of-the-art performance, is precisely what creates its value as a collateralizable asset. Yes, they are treated like specialized high-yield machinery, but they are undeniably a collateralizable asset class. The UCC-1 filings and SPVs you mentioned, they don't detract from the asset status, they confirm its status as a hard asset that has to be legally protected from bankruptcy risk. The underlying security isn't merely the paper contract, it's the physical, scarce hardware that enables the cash flow in the first place. You simply cannot separate the chip from the revenue.
You can, however, separate the consumer from the institutional investor, and that leads us to a crucial distinction, what I'd call the price arbitrage paradox.
Okay, let's talk about the immediate financial upside for those who are quick enough to seize the moment. The prosumer arbitrager. Historically, the data shows an average profit of 25 to 35% on resale during these crunch periods. Right now, high-end cards like the impending RTX 5090, which have the critical VRAM capacity needed for LLMs, are trading on secondary markets for what? 125 to 160% markups over MSRP? For a prosumer who can access credit, the mathematics are currently favoring a kind of high-risk gamble, a potential 171% annual appreciation versus a 12 to 18% APR on consumer credit. This is pure logical hedging against asset inflation. I mean, if the value of the scarce resource is increasing significantly faster than your cost of capital, then buying now rather than saving and waiting is the financially prudent if aggressive maneuver.
I'm sorry, but that is pure high-risk speculation fueled by hype, not investment. It is financially reckless to use consumer credit to bet on this market. You also completely ignore the extreme downside risk. We have historical precedent. When the Ethereum merge happened back in 2022, GPU prices crashed a severe 57% in just 6 months. And those arbitrage profit margins you cite are, well, they're theoretical. They get immediately eroded by platform fees. You lose 12 to 15% on places like eBay instantly. Non-transferable warranties reduce the resale value by another 10 to 20% because buyers discount heavily for that uncertainty.
But that risk is priced into the margin. The profit margin is so significant precisely because of the volatility.
The IRS is the real headwind here. This income is viewed as ordinary income, which subjects resellers to a 15.3% self-employment tax on top of their standard income tax. You are talking about a highly sophisticated trading operation subject to severe taxation and platform erosion, being run by consumers using high-interest personal credit cards. This is not prudent investment. It is the epitome of a speculative frenzy, and it's guaranteed to enrich a few early movers and absolutely crush the majority of latecomers. The asset is just too prone to manipulation and technological shock to ever be considered a stable store of value for the average person.
I grant you, the market is highly volatile. Certainly not for the faint of heart. But I think we have some shared ground here. The truly defensible, the sustainable opportunities lie not in speculating on physical inventory, but in addressing the structural scarcity. And that leads us to the true gold rush, the service economy that's built on top of this crisis.
That is a compelling argument. And I agree. The crisis of physical scarcity is creating massive entry paths for small operators into this burgeoning, $31.89 billion GPU as a service market. We're seeing incredible commercial viability in decentralized networks.
Exactly. I mean, look at Vast.ai, which hosts over 10,000 GPUs, or Pavel Durov's Cocoon network, built on the TON blockchain, and the Liberman brothers' Gonka AI, which is effectively transforming leftover proof-of-work capacity into productive AI inference. For small operators, the economics are clear. An entry-level 810 GPU that costs, say, $3,500 can generate enough revenue to yield a payback period of under 8 months, just by focusing on inference workloads. This model, this distributed infrastructure economy, is the strategic response to centralized oligopoly control.
I acknowledge the massive commercial return on asset utilization, but I would argue that the largest and most defensible opportunity isn't operating the hardware, which still requires massive capital expenditure and is subject to the accelerated obsolescence we already discussed. The true gold is abstracting the limits of the hardware through sophisticated software optimization.
What sort of scale are you talking about? You can only optimize a physical bottleneck so much.
The addressable market for AI inference software optimization stands at an estimated $106 billion in 2025. That is far larger and more defensible than the GPU AIS market itself. This is the true sustainable gold because it isn't subject to depreciation cycles. Look at the evidence. VLLM v0.6.0 achieved 2.7x throughput improvement simply through efficient memory management and scheduling. Or Multiverse Computing just raised $515 million for quantum-inspired compression tech that claims a 95% LLM size reduction. The real ingenuity lies in making the existing scarce hardware perform exponentially better. The challenge, of course, is that software IP and patents create their own kind of lock-in risk.
But you're admitting that the value is still fundamentally derived from mitigating the hardware problem. It's a continuous, expensive treadmill. I think the crisis itself creates a perpetual opportunity. Let's look at point 4, the sustainability and e-waste angle, which ironically, I think reinforces my view that value persists even after the utility ends.
I use the e-waste problem as the ultimate indictment of the industry's obsession with transience. Fewer than 20% of discarded GPUs are properly recycled. This failure to manage the physical product proves the industry's focus on rapid obsolescence, not enduring value. And here is the truly shocking metric. E-waste contains 40 to 800 times more gold per ton than actual ore mined from the earth. The industry is literally throwing away more permanent, enduring gold than it mines because it focuses only on the fleeting utility of the silicon. That is an extreme failure of long-term planning.
I disagree fundamentally that it is a failure. I see it as a massive, unharvested commercial opportunity, a perpetual asset turnover cycle. The $57 billion estimated global value of recoverable raw materials in e-waste suggests exactly the opposite of obsolescence. The discarded chassis of the GPU is still rich in tangible, enduring, permanent assets like copper, silver, and yes, gold. Fully integrated processing facilities can achieve 40% plus margins through precious metals extraction.
But the existence of the opportunity is irrelevant if it's not being capitalized on at scale. The current behavior is to send it to the landfill.
That is changing. And it's changing rapidly because the margins are just too high to ignore. Entrepreneurial models like the data center decommissioning specialist, which requires a moderate capital of, say, $200,000 to $500,000, are emerging specifically to harvest value from this asset turnover. The continuous churn, the constant cycle of obsolescence, it simply creates a perpetual, high-margin circular economy opportunity for those with the capital and discipline to execute it. The value simply transforms from productive utility to material utility. The AI infrastructure crisis has, I think undeniably, elevated DRAM and GPUs past typical commodity status and into a crucial strategic asset class. We've confirmed its ability to secure billions in sophisticated institutional financing through specialized legal structures and its role in defining national technological capabilities through geopolitical stockpiling. While it fundamentally lacks the 5 millennia permanence of physical gold, and we absolutely must acknowledge that distinction, its immediate productive utility and financial leverage make it the dominant, high-risk, high-reward strategic asset of the 2020s. The value here lies in the productive capacity, not the passive store of wealth.
I remain unconvinced by that line of reasoning. The asset fails the fundamental, critical tests of durability and fungibility that are required for any enduring asset. This is a spectacular transient commodity bubble, manufactured by an oligopoly that primarily benefits those manufacturers and the sophisticated enterprise lenders who demand aggressive collateral haircuts. And it's the consumers and small speculators who are exposed to severe and unpredictable risk. The long-term defensible value, the true gold in this rush, lies entirely in the software, the optimization, the compression, and the decentralized services that mitigates the hardware's rapid, inevitable obsolescence.
Ultimately, I think this debate really highlights the necessary and complex distinction between strategic relevance, which these chips unquestionably possess, and intrinsic value, which remains highly volatile, especially in the age of AI.
And the provocative question of whether this new gold will turn to sand by 2028 is left, as always, to the discerning judgment of our listeners.
Welcome to The Explainer. Today we're diving into a really hot topic in the world of AI hardware, all based on some fascinating research from DRAM.Gold. Everyone's asking, is computer memory the new gold? Let's get into it. So, get this. In just the last year, DRAM prices shot up by a staggering 171.8%. I mean, that's not just a little market bump. That's an absolute earthquake shaking the entire tech industry. And this isn't just talk. There's real money behind it. This price surge has created a massive new market. We're now seeing over $11 billion in enterprise loans that are actually backed by GPUs as collateral. You heard that right. Wall Street is literally treating these chips like they're hard assets. That's a huge shift in how the market thinks. Which, of course, leads us to the billion-dollar question. Are we watching the birth of a totally new, super valuable asset class? To put it simply, is DRAM really the new gold? Okay, to really get what's going on, we have to break down why anyone is even comparing computer chips to gold in the first place. This hype didn't come out of nowhere. It's actually rooted in a very real and very strategic supply crisis. The scarcity is just intense. You've got giants like Microsoft and OpenAI with this bottomless appetite for AI hardware. So what do they manufacturers do? Well, the three companies that control almost the entire market have pivoted to making high-margin, high-bandwidth memory for the big guys. This starves everyone else. And the result? Global inventories have just plummeted. This is no accident. It's basically manufactured scarcity. But this is where the whole story takes a very sharp turn. Now, once you look past all the short-term hype, the whole analogy to gold just completely falls apart. I mean, just look at the sheer chaos of the DRAM market compared to gold's stability. It's not even a fair fight. Gold has an average volatility of around 16%. DRAM? We're talking wild annual swings from 50% to over 175%. It's driven by these crazy boom and bust cycles, not some timeless inherent value. And then there's this idea of fungibility. 1 gram of 24-karat gold is, well, it's the same as any other gram of 24-karat gold. Simple. But a memory chip? Oh no. One is not the same as another. You can't just swap DDR4 for DDR5, and the real pros will pay a huge premium for specific versions, like Samsung's B-Die, because it performs better. So yeah, they're far from being a standardized asset. And this right here, this is the fatal flaw in the whole new gold theory: depreciation. Gold that was mined thousands of years ago is still just as valuable today. A memory chip from 2 years ago, It's already on a fast track to becoming e-waste. Tech hardware is designed to become obsolete, a concept that's totally foreign to precious metals. The key thing to understand here is that even though big companies do stockpile chips, they're not doing it as a long-term investment. They're doing it for operational continuity, basically to keep the lights on during a shortage. They know that to stay competitive, they have to keep upgrading, and that makes today's hot-ticket chip tomorrow's useless junk. So, okay, just because chips aren't gold doesn't mean there's no money on the table. This intense short-term scarcity has opened up a very real, but let me tell you, an extremely risky opportunity for arbitrage. That's just a fancy word for buying low and flipping it for a quick profit. Data from the last big GPU shortage shows you exactly how this game is played. You see these headline markups, right? Gross margins around 25%. But once you start factoring in marketplace fees, shipping, all the other costs, that realistic net margin gets squeezed down to around 10%. It is a much, much tighter game than it looks from the outside. For anyone who's bold enough to play, success really depends on a super strict, disciplined playbook. Rule number 1, you only make money if you can buy at the official retail price. Rule 2, sell it immediately. This is not something you hold on to. After the 2022 crypto merge, GPU prices crashed 57% in just a few weeks. And rule 3, you have to watch for the warning signs that the party's about to end. So this brings us to the real sustainable opportunity. And guess what? It's not in flipping hardware at all. The true visionaries, the ones playing the long game, are looking one layer above the physical chips. The core insight from DRAM.Gold's analysis is this. The true gold mine isn't in owning a depreciating asset. It's in building the essential services, from cloud computing to software optimization, that help everybody else deal with the scarcity crisis. That's where the lasting value is being created. So the most obvious example is GPU as a service. You have the centralized players like CoreWeave who are building serious alternatives to the giant cloud providers. But what's really interesting is this wave of decentralized networks like Vast.ai and Gonka AI. They're creating platforms where literally anyone can rent out their idle consumer GPUs. It's a whole new supply chain being built from the ground up. The second big opportunity tackles a huge problem that this hardware boom is creating, e-waste. An incredible 82.6% of electronic waste is improperly thrown away. That's not just an environmental disaster. It's a multi-billion-dollar economic opportunity for anyone who can figure out how to build a circular economy around it. And this opens up several really cool business models. You could be a component broker, buying and reselling tested parts. You could specialize in decommissioning entire data centers when they upgrade their AI gear. Or you could build a business that provides certified testing for used components, a service that's absolutely crucial in a market that's about to be flooded with secondhand parts. But the largest opportunity, and I mean by a long shot, is in software optimization. Instead of just trying to find more hardware, this approach is all about making the hardware we already have work smarter and way more efficiently. It tackles the scarcity problem from a much more scalable and elegant angle. And don't make any mistake, this is not some small niche play. The market for AI inference, that's the actual running of AI models, is projected to be a $106 billion opportunity in 2025 alone. Every single dollar of that is a potential customer for software that can cut their costs and boost their performance. Now, a lot of the underlying tools for this stuff are open source, but the real business opportunity isn't in the code itself. The truly valuable companies are going to be the ones that provide enterprise-grade services, performance guarantees, and specialized expertise for specific industries, like finance or healthcare. So, what does this all mean for the next few years? Well, all these trends are building towards a major inflection point for the whole market, and it is absolutely crucial to be positioned for what's coming next. Okay, think of it like this. Right now, we are in a window of peak scarcity. This is the golden hour for arbitrage plays and for these service layer businesses to get a foothold. But that window is closing. By 2027, new manufacturing plants are set to come online. That's going to start to normalize supply, it's going to squeeze hardware margins, and it could very well burst this whole speculative bubble. And that leaves us with one final, pretty provocative question. When this hardware boom inevitably ends, are you going to be the one left holding a pile of rapidly depreciating silicon? Or will you own a piece of the sustainable service layer that was built to manage it all? Fortunes are going to be made and lost in this transition, and the winners will be the ones who truly understood the difference between temporary scarcity and real, lasting value.